Now, e-commerce platform Meesho's 5,421 crore IPO opens today. We have the management joining us, but we want to set this up with what Meesho does, a little bit about how it's different in terms of how it makes its money compared to other platforms and more. Mangalam is standing by with the details. Mangalam, over to you.
That's right. So the IPO opens today. It's a 5,400 crore IPO, of which fresh issue is close to 4,250 crores. And at the upper end of the price band, the company is actually seeking a valuation of almost 50,096 crores or 50,100 crores. And there had been a strong demand from the anchor investors as well. Yesterday, they raised about 2,400 crores from the anchor investors. The book was subscribed 32 times, so 80,000 crore worth bids coming in from the anchor investors. And SBI Mutual Fund was the key out there, which picked up 25% of the allotted stake for anchor investors. The others were GIC, BlackRock, Fidelity, and the others. Now, Meesho is obviously India's largest e-commerce platform, and the moat is that they do not charge sellers any commission or platform fees to consumers. How is it that they make money? They monetize their platform via services to sellers such as fulfillment, which is logistics, advertising, and data insights. The important part, it's a pure Bharat app where 87% of its transacting users actually come from outside of top 8 cities. And in the first half of this year itself, they had around 234 million transacting users. That's about 23 crore or 1 in 6 Indians. The opportunity, India has nearly 700 million smartphone users, and online shoppers are just around 250 to 270 million. So that's the headroom out there. As far as their financials are concerned, last year they did about 10,000 crores on the top line, but on a reported basis, they are still loss-making on EBITDA as well as the net loss. The first half of this year as well, the adjusted EBITDA loss was close to around 700 crores, and the net loss was also 700 crores on a 5,600 crore top line. The company looks at free cash flow as a growth metric, profitable metric for them, and their contribution margins are 3.8% for the first half of this year versus 4.9% last year. For all of this, what are they valued at? Now, because it's a loss-making company on a reported basis on EBITDA and net profit, we're looking at price to sales. It's much lower than Eternal, Lenskart, and Trend. But remember, the profitability is nowhere close to the others as well. At around 5.3, it's pegged closer to Avenue Supermarts, with the news that their profitability is not very close to Avenue Supermarts or the others that we're talking about right now. So what we need to know from here on is the growth path and the path to profitability for the company. They've been talking about growing at free cash flow level and at the same time looking at increased share of revenue coming in from advertising. That would be a margin lever for them.
Absolutely. And thanks very much, Mangalam. Really sets the ground for us to quiz the management.